coming up on Retiring Well with Michael Reese.
Using life insurance is kind of like doing a Roth conversion, but you've got the insurance company through the death benefit paying the tax for you to do that conversion. Insurance company, same 100,000, same liquidity, but now it's paying him maybe 4% a year. And in the event that he dies or he needs long-term care, he gets an extra $50K.
You want to make sure that you structure that type of policy correctly, because you can get into trouble if not.
Right, and also too, the types of life insurances are going to be different from the life insurance you're getting when you're 30 to where you're 62.
Retiring Well with Michael Reese, helping you make smart decisions with your money so you can live a better life. Today is the day you can take back control of your money. Retiring Well with Michael Reese, where we believe your best is yet to come.
Welcome to Retiring Well. I'm your host, Michael Reese, and I'll tell you what, I love today's show. We are talking about life insurance and how people who are retired use life insurance to benefit their planning. Now, I don't know about you, but I remember, I'm a certified financial planner. I remember even in earlier classes, sometimes there was this old adage out there where it would be, all right, once you're getting into retirement, you don't have minor children anymore or anything, the mortgage is paid off, you're retired, you don't really need life insurance anymore. So it's time to get rid of that life insurance. You just don't need it, let's get rid of it. Cash it in, whatever you got. Now, that was great. However, and one of the things I learned in my certified financial planning classes is that's very short-sighted, because there's a lot of reasons that life insurance actually is a terrific asset to hold during retirement. And we're going to talk about, right now at least 3 reasons why that's the case. Okay, so number one good reason is if you're married, there is no better asset to leave your surviving spouse when you die. I mean, think about it. You die, your surviving spouse suddenly gets a tax-free lump sum of money. Man, he or she we'll say it's a she, because us men, we don't usually live as long. So let's say your wife survives you, she gets this big old tax-free lump sum of money, of cash. She can use that to replace some lost income. She can use that to maybe convert IRAs to Roth IRAs. If she wants to do some gifting to the children, she could use it for that. I mean, there's all kinds of reasons that she could use that tax-free lump sum of cash. And I promise you this, from a financial perspective, nothing is better than a big old tax-free lump sum of cash when somebody dies, at least insofar as the financial side goes. All right, how about reason number 2 to hold life insurance during retirement? I'll tell you what it is. It's all the rage these days. It's long-term care planning. Some of the best long-term care plans right now are held on life insurance chassis or in a life insurance contract. And essentially, what happens is you have your life insurance. If you need long-term care, it pays out a benefit, but if you don't, hey, you get all your money back and then some through the death benefit. In other words, it's not a use it or lose it approach for long-term care. People in retirement seem to really like that type of structure. How about reason number 3 to hold life insurance during retirement? Well, it has to do with leaving a legacy to children, grandchildren, or charities. A lot of people we talk to, they say, here's what they tell us. They say, I want to live my retirement, and I want to live my retirement to the fullest, right? You want to have a terrific retirement. And it's okay if you spend all your money down during those years. If you die and leave your kids nothing, that's okay. We hear it all the time. But at the same time, it would be nice to leave them something. We just don't want to change our lifestyle to leave them that something. Well, if you held life insurance, you could spend down all of your money that you wanted to, knowing that at the end of the day when you die, that life insurance kicks in a big old death benefit to your children, grandchildren. It's especially cool when you combine life insurance with charities. There are a lot of cool things you can do there. So there's 3, surviving spouse, long-term care, and children, grandchildren, charities. I'm going to go ahead and give you a little bonus, all right? So here we go. Bonus reason to use life insurance during retirement. IRA rollouts. One of the toughest things about retirement is IRAs. A lot of people have a lot of money in IRAs, big taxable accounts. But what happens is, the question is usually, how do we move money from IRA into tax-free accounts and do so in a cost-effective way? If you do it right using life insurance, you can roll from those IRA taxable accounts to tax-free life insurance, and when all is said and done, you can get the insurance company to pay the tax on that transition for you. I'll tell you what, if you're not looking at that as an option with your planning, you're really missing out. There's some really neat things you can do there. So there you go, folks. Life insurance during retirement. A lot of good reasons to use it. And I don't want you going anywhere, because as we continue on in the show, we are going to dive in and explore the different benefits that life insurance can have with your retirement planning.
The new Trump tax code opens the window to potentially saving thousands on your IRA. Learn how to take advantage of the new law at a dinner evening with your Retiring Well TV hosts from Centennial Wealth Advisory. This is a no-cost, information-only, no-pressure event with a fine dining experience you won't soon forget. Important topics we'll discuss are 3 ways to use the new tax code to move money into tax-free accounts at reduced rates, hidden tax-related pitfalls that most advisors are missing, the importance of managing risk and the effect of volatility on your retirement savings, the #1 mistake most Americans are making with their retirement accounts. Are you one of them? And much more. Dinner is on us, and there is absolutely no obligation. Call 888-608-5825 to register and choose the date and location that is most convenient for you. Tuesday, May 15th at the Otsego Club and Resort in Gaylord. Wednesday, May 16th, or Tuesday, May 22nd at Boone's Long Lake Inn in Traverse City. Presentations start at 6 p.m. and are free to attend with a complimentary gourmet dinner to follow, but seating is limited and fills quickly. Call 888-608-5825 to reserve your seats today. Don't miss this important presentation and learn how the new tax code opens the window to potentially saving thousands. Call 888-608-5825 today.
Welcome to Chalk Talk. This week we are looking at the different uses of life insurance with retirement planning. And what we're going to talk about in this session is IRAs and comparing the concept of doing a Roth conversion versus doing something called an IRA rollout into certain types of life insurance. So this is I think you're really going to like this. So here in our example, we have a $500,000 IRA. So right here, $500K. Now, it's very common in our practice, and with a lot of tax planners, it's very common for us to take a look at converting portions, if not all of that $500,000 over a period of time into a Roth IRA. And the benefit is what? You get it over here to a Roth IRA, everything is, of course, tax-free. We love tax-free. Best 2 words on the planet as far as we are concerned here at Retiring Well. Now, what is the disadvantage to doing a Roth conversion? Well, the disadvantage is you're going to pay tax on the amount of money that you convert over into that Roth environment. If you take $100,000 of this and put it over into a Roth, you're going to owe tax on $100,000 of income. And you're never going to get that tax back. That's just how it's going to be. Now, let's take a look at using life insurance as an option inside. Instead of a Roth, what if we, instead of putting the $100,000 over here in a Roth conversion, what if instead we took that same amount of money and we put it into specially designed life insurance? Now, what's interesting is we're still going to have to pay tax on that $100,000 that we took out of the IRA, right? We're still going to owe tax on $100K, call it $30,000 or $25,000, whatever it is. But what's interesting is whatever's left over gets invested inside that life insurance contract. Up here with a Roth, when you do a Roth conversion, you convert 100,000, you give 25, 30 to the IRS, there's 70, 75 left over, you invest it in a Roth IRA into various investments. Same thing's happening, but this time instead of at a Roth, it's at a life insurance company. But here's what's interesting. If you do this the right way, just like a Roth, everything in the life insurance is also tax-free. Again, assuming you follow the rules, right? So here we've got tax-free investments. Here we've got tax-free investments. Essentially, we've done the same thing. There's not much of a difference here. There's one really important difference, though. That life insurance has something called a tax-free death benefit. Death benefit. And that death benefit might be twice the amount of money you put in there. You put in $75K, the death benefit might be $150K or something like that. What does that really mean, though? What it means is this. Time goes on. Maybe you've pulled money out of these accounts, tax-free, that's fine. But someday out there, you're going to die. We all know that. The minute you die, what happens? From here, a death benefit is paid. If you die with money in a Roth IRA, let's say you died, there's $200,000 in your Roth IRA. How much do you get? How much does your family get? $200,000. But if you die and there's $200,000 in cash value in life insurance, what's your family get? They might get $300,000 or $400,000 tax-free. And guess what that extra money essentially does? When that extra money comes in and it pays your family, isn't that extra money more than the tax that you ever paid when you did that, you took the money out when you did that rollover? In other words, using life insurance is kind of like doing a Roth conversion, but you've got the insurance company, through the death benefit, paying the tax for you to do that conversion. How cool is that, right? I mean, think about that. How cool is that? The insurance company's paying the tax. You're not. It's like you pay it initially, but they'll pay you back and then some. Kind of a very interesting deal. So anytime you're in a position where you're looking at doing maybe like a Roth conversion, if you're insurable, you should also take a look at these insurance plans, because there might be a nice little strategy there to help you retire well.
The new Trump tax code opens the window to potentially saving thousands on your IRA. Learn how to take advantage of the new law at a dinner evening with your Retiring Well TV hosts from Centennial Wealth Advisory. This is a no-cost, information-only, no-pressure event with a fine dining experience you won't soon forget. Important topics we'll discuss are 3 ways to use the new tax code to move money into tax-free accounts at reduced rates, hidden tax-related pitfalls that most advisors are missing, the importance of managing risk, and the effect of volatility on your retirement savings. The #1 mistake most Americans are making with their retirement accounts. Are you one of them? And much more. Dinner is on us, and there is absolutely no obligation. Call 888-608-5825 to register and choose the date and location that is most convenient for you. Tuesday, May 15th at the Otsego Club and Resort in Gaylord. Wednesday, May 16th, or Tuesday, May 22nd at Boone's Long Lake Inn in Traverse City. Presentations start at 6 p.m. and are free to attend with a complimentary gourmet dinner to follow, but seating is limited and fills quickly. Call 888-608-5825 to reserve your seats today. Don't miss this important presentation and learn how the new tax code opens the window to potentially saving thousands. Call 888-608-5825 today.
It's your retirement. How will you live it? How will you be remembered?
Will you be able to take me on vacation?
Will you be there for my ball games?
Will you teach me your values? Will you be able to play with me?
Oh, help me go to college. How will I remember you?
Have the retirement you dream about. Contact us today.
Welcome back. This week we've been talking about life insurance and how it's a great asset to hold during retirement. What we haven't talked about, though, today is a really interesting way to use life insurance that a ton of people are using, but I don't think we talk about enough. And it has to do with something called single premium life as an alternative to holding cash. So let's talk about this for a minute. What is the problem today with holding cash? You know, we've got a lot of clients that are holding a lot of money in cash. And in fact, I had one just the other day came to me, he said, Mike, I'm sitting on over 100 grand sitting in cash and just sitting at the bank. And I asked him, I said, Tom, how long has that money been at the bank? And you know what he told me? Oh gosh, forever, right? I mean, it's like, it's there for an emergency, but gosh, I don't expect to use it. It's just there as kind of my emergency money. And what do you think his frustration was with the cash that he held at the bank? What was his frustration? Well, you know what it was. It wasn't paying anything. In fact, he told me, he goes, yeah, I've even been going online, look at these online banks to try to get close to 1%. He goes, it's ridiculous how you don't make any money in these banks. It's like almost I got to pay them to hold on to my cash. And yeah, he's true. I mean, the way interest rates are today, liquid cash at the bank, it doesn't make any money. On top of that, I mean, think about this. I said, well, gee, Tom, if you need long-term care, how much money at the bank there do you have to pay for long-term care? He goes, well, what do you mean? I said, well, you got 100 grand in the bank. You have long-term care, how much does the bank give you to pay for long-term care? Well, he goes, just the 100,000 I have there. Yeah, that's right. And by the way, Tom, when you die, how much of that 100,000 goes to your spouse and to your kids if your spouse dies first? Well, Mike, duh, 100 grand. And at this point, he's looking at me kind of stupid, right? Like, Mike, you're an idiot. And, you know, I probably imagine you're thinking the same thing right now. But then, wait a minute. I said, now, hold on. So if you hold your 100,000 at the bank, as I understand it, it's liquid. You have access to that money at any time, correct? Yes. But you never use it, but it's there if you need it, correct? Yes. And if you need long-term care, you got 100,000. Yes. And if you die, your spouse or your children get 100,000. Yes. Okay, I got it. I said, well, now, here's something interesting. What if you took that same $100,000 and instead of holding it at the bank, what if you put it in one of these single-pay life insurance contracts? So instead of the bank holding your 100,000, now the insurance company holds your 100,000. What happens then? Well, in his case, here's how it worked out. First, just like the bank, his 100,000 was 100% liquid, meaning if he wants the money, bang, he can get at it no problem. The difference is at the bank he can probably go, I don't know that you can pull 100,000 in cash out anytime. I don't know anybody would, but I mean, he could write a check or something. He might have to wait a week from the insurance company, but you know, they're both liquid. He can get at that money whenever he needs it. But how about this? What if he needs long-term care? Well, now instead of having 100,000 to pay for long-term care, the insurance company says, you know what, Tom? If you need long-term care, we'll give you more like 150,000. What if he dies? What does his wife get or his children? Well, instead of 100,000, they might get like 150,000. In other words, the money's still liquid, but there's more for long-term care and there's more for life insurance. But oh wait, what was the number one reason Tom was unhappy with money at the bank? What was that again? Oh yeah, it doesn't pay him any interest. Well, what if this single-pay life insurance plan, while giving him all this other stuff, also paid him typically over time, 3, 4, 5% a year interest? What about then? So, bank, 100,000, earns nothing, gives no benefit for a death benefit or long-term care. Insurance company, same 100,000, same liquidity, but now it's paying him maybe 4% a year. And in the event that he dies or he needs long-term care, he gets an extra $50K. What do you think, Tom? Bank, insurance, which one you want? What's the downside of the insurance? You gotta qualify. You have to go through a medical exam. That's it. As long as you qualify, you get all those benefits. That was an easy decision for Tom. Has your advisor talked to you about that? Maybe they should. Pretty cool way to own some life insurance, isn't it?
The new Trump tax code opens the window to potentially saving thousands on your IRA. Learn how to take advantage of the new law at a dinner evening with your Retiring Well TV hosts from Centennial Wealth Advisory. This is a no-cost, information-only, no-pressure event with a fine dining experience you won't soon forget. Important topics we'll discuss are 3 ways to use the new tax code to move money into tax-free accounts at reduced rates, hidden tax-related pitfalls that most advisors are missing, the importance of managing risk, and the effect of volatility on your retirement savings. The #1 mistake most Americans are making with their retirement accounts. Are you one of them? And much more. Dinner is on us, and there is absolutely no obligation. Call 888-608-5825 to register and choose the date and location that is most convenient for you. Tuesday, May 15th at the Otsego Club and Resort in Gaylord. Wednesday, May 16th, or Tuesday, May 22nd at Boone's Long Lake Inn in Traverse City. Presentations start at 6 p.m. and are free to attend with a complimentary gourmet dinner to follow. But seating is limited and fills quickly. Call 888-608-5825 to reserve your seats today. Don't miss this important presentation and learn how the new tax code opens the window to potentially saving thousands. Call 888-608-5825 today.
Hi, I'm sitting here with Larry Flynn. Thanks for being here, Larry.
Thank you, Mike.
He's one of the advisors at Centennial Wealth Advisory. And folks, as you may know by now, we certainly invite you to come visit with us. It's absolutely free to get a second opinion on your retirement planning. And I think it's important to get a second opinion from someone who's a specialist when it comes to retirement planning. And Larry, I'm sure they're wondering, if they pick up the phone and they call and come visit with you, what can they expect? What's that experience like?
Well, Mike, they can expect not to get hard sold, okay? We're going to greet them warmly. We're going to sit down and talk to them a little bit about maybe their story, where they're from, where they grew up, how they met their spouse, what they're dreaming of doing once they get soon to be retired or retired.
Kind of what are their goals, right?
Yeah, what are your goals? We're going to talk to them a little bit about who we are, what we do, show them how we do things, especially dealing in the market realities we find ourselves in today.
Got it. So essentially, they're coming in, you're learning a little bit about what's important to them, what their goals are, what they're trying to accomplish. I'm sure you're taking a look at what they're doing so far. You maybe share a little bit about you, and it's just in a very relaxed atmosphere.
That's right.
And there's no cost to do this. Is that correct?
No cost. No cost.
All right. So, folks, there you go. I mean, it sounds very simple, very easy, very laid back. There's no reason for you not to just pick up the phone, call the number on the screen, come visit us, get that second opinion. You'd be glad that you did.
Thank you for joining us again today. My name is Art Canfield. I'm here with John Torbett. And today we're going to continue the conversation talking about the uses of life insurance in retirement planning. Now, obviously, life insurance, a lot of different uses throughout your whole life, really, for that. But we're going to specifically talk about how that can be used in retirement planning.
Yeah, and it makes me think of a case recently, Art, where we were talking about these folks. They were fortunate enough to have a significant amount in their IRA accounts where they said, okay, this is going to be an issue as time moves along, and if one of us were to pass away, we recognize there's going to be a significant amount of taxes that we're going to pay on this over time. And so we ultimately looked at, okay, how can we maybe transition some of this money out of the IRAs and do it in a tax-free way. And so it was ultimately using life insurance, where we set up life insurance policies for each of them, and they were drawing money out just on a regular basis out of the IRAs to fund this type of life insurance, where it provides that tax-free death benefit, but then a big thing too that a lot of these life insurance policies will do today when you find the right ones is they'll provide some long-term care benefits as well. So it's a pretty interesting way to look at not just covering IRAs, but how life insurance can actually be a part of the overall plan.
Right. And so a lot of people, I think, when you get to a certain age, this idea of that you don't need life insurance anymore. And for the most part, some of the reasons why maybe you and I would have life insurance too, if you or I passed away and wanted to provide for our kids, stuff like that, a lot of that now isn't necessarily true for people in their 70s, 80s, 90s, whatever it may be. And so the focus changes a little bit, and that's kind of what you're saying. The example you give where the couple had this kind of, they were fortunate to have a big IRA, was going to have kind of what we call a tax bomb on if one of them passed away, and using life insurance to efficiently transition some money out if one of them was to pass away.
Yeah, and I think of another case that I'm working with a client on right now where they're ultimately, it's a second marriage, and so their concern is primarily to make sure that their spouse is going to be well taken care of when they're gone. And in this case, he's a little bit older than she is, and so he's wanting to basically have that comfort level of knowing, okay, if I were to draw down my retirement accounts, then I want to make sure that this lump sum is left behind. And so again, where life insurance plays as a valuable tool at that time. And the big thing with that is you want to make sure that you structure that type of policy correctly, because you can get into trouble if not.
Right. And also too, the types of life insurances are going to be different from the life insurance you're getting when you're 30 to where you're 62. Because if you get a 20-year term policy, let's say, and you live past 20 years, it's not going to be so good.
Right.
So
and that's where there's ways where you can do it where it's just a level amount and there's a set death benefit amount, so you don't have any surprises or anything. That's really the big thing that you want to avoid when it comes to retirement planning. You don't want those big surprises.
Sure. And we've had some other cases I know kind of where a couple, either whether it was a child or grandchild, they really had it set in their mind they wanted to leave a set amount behind, whether that was $10,000 or more or less. But they were really concerned that, okay, how do I know how much money I can spend but still leave this money behind? Well, having some sort of life insurance policy in place is one way to legacy plan to be able to allow that to happen.
And it's surprising too. I mean, a lot of times people think, oh, especially when it comes to retirement, they say, oh, I'm too old, or no, I had this cholesterol issue or whatever, too expensive and everything. And surprisingly, I mean, it's an insurance company. They're looking at your average life expectancy and what the costs may be, and they set it where it can make financial sense for you to set that up as part of the overall plan.
Right. And I think, just like everything we talk about, the importance is really just coming in, getting that second opinion about it. Whether you have it or don't have it, it may or may not make sense to have it in your plan.
Right, and that's really the big thing is, I mean, we're bringing up examples today where that may be the minority that we're talking about, but it's where each and every individual couple's situation is a little bit different, and it's understanding exactly what they're trying to accomplish, and then it's our job to make sure that we match up those goals with the appropriate tools.
Well, if John and I have something that we've said is interest to you, or maybe you have an existing life insurance policy you would like reviewed, or think of something that we said that might be of interest to you, please give us a call. Call the number on the screen. We'd be happy to talk through this with you and sit down and see if this makes sense for you and your family. Thanks for joining us, and have a great week.